Richard retired at 63, 41 years as an engineer at Boeing. He had a rental property he bought in 1989 for $87,000 that was now worth $620,000. He had stock in his company that he accumulated through employee stock purchase plans over 3 decades. He had a small business consulting practice on the side, and he had a life insurance policy his father took out for him in 1978 that had built up significant cash value. His financial advisor told him to wait. Don't sell anything yet. You just retired. Let the dust settle. Give it a year. So Richard waited. He filed for Social Security at 63. He started Medicare at 65. And then, in his second year of retirement, he decided it was time. He sold the rental property. He sold the Boeing stock. He liquidated the consulting business, and he cashed out the life insurance policy. The capital gains alone were $287,000. The depreciation recapture on the rental was another $64,000. The life insurance surrender triggered $31,000 of taxable gain, and the business sale added $52,000 to his income. In a single tax year, Richard reported $434,000 in additional income on top of his pension and Social Security. His federal tax bill was $103,000. His state tax bill was $38,000. But that is not even the worst part. That income from 2 years ago just set his Medicare Part B and Part D premiums for this year. His monthly premium went from $174 to $594. That is an additional $5,040 per year in Medicare costs for the next 12 months because of income he reported 24 months ago. Richard lost $146,000 in a single decision. Not because he sold the wrong things, because he sold them at the wrong time. If Richard had sold those exact same assets in the final year before he retired while he was still working, his tax bracket would have been exactly the same, but his retirement income in the following years would have stayed low enough to avoid every single Medicare surcharge. The 5 things I'm about to show you are the 5 things the IRS is waiting for you to sell after you retire. Because the moment you do, they get to tax them at the highest possible rate, while simultaneously triggering a 2-year penalty on your Medicare premiums that you cannot undo. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Arthur Vance. I am a federally licensed enrolled agent. Every week on this channel, I show retirees the strategies the IRS does not advertise, and the moves that financial advisors either do not know or do not bother explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let us get into it. Asset number 1. Highly appreciated stock positions, especially company stock from an employee stock purchase plan. When you work for a company and participate in their employee stock purchase plan, you accumulate shares over years, sometimes decades. You buy them at a discount, the stock price climbs, and by the time you retire, you might be sitting on shares you bought for $15 that are now worth $180. Most retirees think the smart move is to hold those shares into retirement and sell them slowly as needed. That is exactly backwards. Here is why. When you sell stock, you pay capital gains tax on the difference between what you paid and what you sold it for. Long-term capital gains rates are 0%, 15%, or 20% depending on your taxable income. In 2026, the 0% rate applies to income up to $96,700 for married couples filing jointly. The 15% rate applies from $96,700 up to $600,050. Above that, you hit 20%. But those are just the federal brackets. There is also the 3.8% net investment income tax that kicks in at $250,000 for married filers. And then there is the Medicare IRMAA cliff. If your modified adjusted gross income exceeds $206,000 for a married couple, your Medicare premiums jump. The first IRMAA tier adds roughly $70 per person per month. The second tier adds $175 per person per month. The third tier adds $280 per person per month, and it goes up from there. Those premium increases last for 12 months, and they are based on income from 2 years prior. So if you sell $200,000 worth of appreciated stock in 2026, that income hits your 2026 tax return, and your 2028 Medicare premiums get surcharged. You cannot undo it. Now let me show you what happens if you sell that stock in your final working year instead. You are still employed. Your W-2 income is already high. You are already in the 22% or 24% bracket. The capital gain from selling the stock does not push you into a higher Medicare tier because you are not on Medicare yet. You are still on your employer's health insurance. You pay the capital gains tax at the same rate you would have paid in retirement. But the key difference is this. Once the stock is sold and the tax is paid, that money is now in a brokerage account or a money market fund. When you retire and start withdrawing from that account, you are only taxed on the gains that occurred after the sale. The big taxable event already happened while you were still working. Your retirement income stays low, your Medicare premiums stay low, and the money is available to you in cash without triggering a massive income spike in a single year. Let me put real numbers on this. Say you have $400,000 worth of company stock with a cost basis of $120,000. Your unrealized gain is $280,000. If you sell it all in retirement, that $280,000 hits your income in 1 year. At the 15% capital gains rate plus the 3.8% net investment income tax, you pay $52,640 in federal tax. Your state might add another $15,000 to $20,000 depending on where you live. And if that sale pushes your income over the IRMAA threshold, you pay an extra $4,000 to $6,000 in Medicare premiums over the following 12 months. Total cost, roughly $72,000 to $78,000. Now do the exact same sale in your final year of work. You pay the same $52,640 in federal capital gains tax. You pay the same state tax. But you avoid the Medicare surcharge entirely because you are not on Medicare yet. You save $4,000 to $6,000 immediately. And more importantly, your retirement income for the next 10 years stays below the IRMAA thresholds, which means you save that $4,000 to $6,000 every single year. Over a decade, that is $40,000 to $60,000 in Medicare costs you never have to pay, just by changing the timing of one sale. Asset number 2, rental properties with significant depreciation recapture. If you own a rental property, you have been claiming depreciation on that property for every year you have owned it. Residential rental property depreciates over 27.5 years. So if you bought a rental property for $300,000 and the land was worth $75,000, you have been deducting roughly $8,182 per year in depreciation. That depreciation reduces your taxable rental income every year. It is a phantom deduction. The property is not actually losing value. In fact, it is usually going up. But the IRS lets you deduct it anyway. Here's the trap. When you sell that rental property, the IRS recaptures all of that depreciation and taxes it at 25%, not 15%, not your ordinary income rate, 25% flat. This is called unrecaptured Section 1250 gain, and it is one of the most overlooked tax bombs in the entire code. Let me show you what this looks like. You bought a rental property in 1998 for $180,000. You have owned it for 28 years. You have claimed roughly $147,000 in cumulative depreciation. The property is now worth $620,000. When you sell, your capital gain is $440,000. But that gain is split into two pieces. The first $147,000 is depreciation recapture, taxed at 25%. The remaining $293,000 is long-term capital gain, taxed at 15%, assuming you are in that bracket. The depreciation recapture alone costs you $36,750. The capital gain adds another $43,950. Total federal tax, $80,700. Your state adds another $20,000 to $30,000 depending on where you live. And if this sale happens in retirement and pushes your income over $206,000, you trigger IRMAA surcharges on top of everything else. Now here's what most retirees do not realize. If you sell that rental property in your final year of work, the tax treatment is identical. The depreciation recapture rate does not change. The capital gains rate does not change. But what does change is the timing of the income. You take the hit while you are still working, while your income is already high, and while you are not yet subject to Medicare premium surcharges. Once you retire, the property is gone, the tax is paid, and your retirement income no longer includes a $440,000 spike that destroys your Medicare premiums for the next 2 years. But here is the move almost nobody knows about. If you are going to sell the rental property anyway, sell it in the year before you retire and do a 1031 exchange into a Delaware statutory trust or a real estate investment trust that generates passive income. The 1031 exchange lets you defer the capital gains tax and the depreciation recapture entirely. The money rolls into a new investment that generates monthly income without ever hitting you with a taxable event. You still have access to real estate returns, you still have cash flow, but you have eliminated the tax bomb that would have destroyed your Medicare premiums in retirement. Asset number 3, ownership in a closely held business, especially if it is structured as a C corporation. If you own a business and you have been running it as a C corporation, selling that business after you retire can be one of the most expensive mistakes you will ever make. Here is why. C corporations are taxed twice, once at the corporate level and once at the individual level when you take money out. When you sell a C corporation, the corporation itself pays tax on the gain. Then, when the remaining cash is distributed to you as the shareholder, you pay tax again on that distribution as a dividend. This is called double taxation, and it is brutal. But here's what makes it worse in retirement. If you sell the business while you are retired, the dividend income you receive from the sale lands on top of your Social Security, your pension, your IRA withdrawals, and everything else. That income can push you into higher tax brackets, make more of your Social Security taxable, and trigger the exact same Medicare IRMAA cliffs we have been talking about. Let me show you the numbers. Say you own a small consulting business structured as a C corporation. You have been running it for 20 years. You sell the business for $850,000. The corporation pays tax on the gain at the corporate rate, roughly 21%. After corporate tax, you have about $671,500 left. When that money is distributed to you as a dividend, you pay another 15% to 20% in federal tax depending on your income level. Let us say 15%. That is another $100,725 in federal tax. You are now down to $570,775. Your state takes another 5% to 7%. Let us say $42,000. You are down to $528,775 out of an $850,000 sale. You just lost $321,225 to taxes. But wait, that $671,500 dividend hit your tax return in the year you sold the business. If you are retired and on Medicare, that income just triggered IRMAA surcharges for the next 12 months, starting 2 years from now. Add another $5,000 to $7,000 in Medicare premium increases. You just lost $328,000 on an $850,000 business sale. Now here's the alternative. Sell the business in your final year of work. The corporate tax is the same. The dividend tax is the same. You pay the same total tax bill. But the timing is different. You take that dividend income while you are still working, while your income is already high, and while you are not yet on Medicare. The tax bill is identical, but the Medicare penalty disappears. That is $5,000 to $7,000 saved immediately. And your retirement income going forward does not include the massive dividend spike that would have pushed your Medicare premiums into the stratosphere. But here is the even better move. If your business qualifies as a qualified small business under Section 1202 of the tax code, and you have held the stock for at least 5 years, you can exclude up to $10 million of gain from federal taxation entirely. This only works if the business is structured as a C corporation and you sell the stock, not the assets. Most small business owners have never heard of Section 1202. Most accountants do not bring it up unless you ask. But if your business qualifies, selling it before you retire while structuring the sale as a stock sale instead of an asset sale can save you millions in federal taxes. Not reduce them, eliminate them. Asset number 4, collectibles, art, coins, precious metals, or anything else taxed at the 28% collectibles rate. Most people do not realize this, but when you sell collectibles, the IRS taxes the gain at a maximum rate of 28%, not 15%, not 20%, 28%. This applies to artwork, rare coins, precious metals, gems, antiques, stamps, certain types of bullion, and even some rare cars. If you have been collecting gold coins for 30 years and you sell them in retirement, every dollar of gain is taxed at 28%. And here is the kicker. That 28% rate applies regardless of how long you held the item. It does not matter if you bought the coin in 1985. The gain is still taxed at 28%. Now let me show you why this becomes a retirement trap. Say you have been buying gold coins as a hedge against inflation. You have $150,000 worth of gold with a cost basis of $40,000. Your gain is $110,000. If you sell that gold in retirement, you pay 28% federal tax on the $110,000 gain. That is $30,800. Your state adds another 5% to 7%, let us say $6,000. You just paid $36,800 in taxes. And if that $110,000 gain lands on top of your other retirement income and pushes you over the IRMAA threshold, add another $4,000 to $6,000 in Medicare surcharges. Total cost, over $42,000. But if you sell that gold in your final year of work, the tax rate is identical. You still pay the 28% collectibles rate. But the income hits your return while you are still working, while you are still on employer health insurance, and before Medicare premiums become an issue. You pay the same $30,800 in federal tax. You pay the same state tax. But you avoid the Medicare surcharge. That is $4,000 to $6,000 saved. And once the gold is sold, the cash sits in your account generating little to no taxable income going forward. Your retirement income stays low, your Medicare premiums stay low, and the money is available without triggering another 28% tax event. Now I want you to stop for a second and think about this. We have covered 4 assets so far: stock, rental property, business ownership, and collectibles. Every single one of them has a tax rate that does not change based on when you sell. The tax rate is the same before retirement and after retirement. So why does it matter when you sell? Because the IRS does not just tax the sale. They tax the income that the sale creates. And that income affects everything else on your tax return for that year and for the 2 years that follow. When you sell assets in retirement, the income spike makes more of your Social Security taxable. It pushes you into higher marginal tax brackets. It triggers the 3.8% net investment income tax, and it sets your Medicare premiums for the next 24 months based on income you had in one unusual year. Selling the same assets before retirement avoids all of those secondary penalties. Not because the tax law changed, because the timing changed. Drop a comment right now with the number of the asset that surprised you the most. Was it number 1, the company stock? Number 2, the rental property? Number 3, the business sale? Or number 4, the collectibles? Let me know in the comments because the most common answers will shape next week's video. Asset number 5, whole life or universal life insurance policies with significant cash value buildup. This is the one almost nobody talks about, and it is the one that catches retirees completely off guard. If you have a permanent life insurance policy that has been in place for 20, 30, or 40 years, that policy has likely built up substantial cash value. That cash value grows tax deferred as long as the policy stays in force. But the moment you surrender the policy and take the cash, the IRS treats the gain as ordinary income, not capital gains, ordinary income. Let me explain how this works. Say you bought a whole life policy in 1985. You have paid $180,000 in premiums over the last 40 years. The cash value is now $290,000. If you surrender the policy, you get a check for $290,000. But the IRS sees $110,000 of that as taxable gain. That gain is taxed as ordinary income at your marginal tax rate, which could be 22%, 24%, or even 32% depending on your total income. If you surrender that policy in retirement, that $110,000 of ordinary income lands on top of your pension, your Social Security, and your IRA withdrawals. At the 24% bracket, you just paid $26,400 in federal tax. Your state adds another $5,000 to $7,000. And if that $110,000 pushes your income over the Medicare IRMAA threshold, add another $4,000 to $6,000 in premium surcharges. You just lost $37,000 on a policy you thought was giving you $290,000. Now here is the move. If you are going to surrender the policy anyway, do it in your final year of work. The ordinary income rate is the same. You still pay the 24% federal tax. You still pay the state tax. But you avoid the Medicare surcharge because you are not on Medicare yet. That saves you $4,000 to $6,000 immediately. But here's the better move. Do not surrender the policy at all. Do a 1035 exchange. Section 1035 of the tax code allows you to exchange one life insurance policy for another or exchange a life insurance policy for an annuity without triggering any taxable event. You can take that $290,000 cash value and roll it into a single premium immediate annuity that pays you $1,800 a month for the rest of your life. No taxes due on the exchange. The income you receive from the annuity is partially taxable and partially a return of your basis, which means you are getting cash flow without the massive ordinary income hit. Or you can exchange the policy for a long-term care rider that covers nursing home costs down the road. Either way, you have turned a tax bomb into a tax-efficient income stream without ever writing a check to the IRS. Now let me tie all 5 of these together, because here's the pattern the IRS does not want you to see. Every single one of these assets has a tax rate that is set by law. Capital gains are taxed at 15% or 20%. Depreciation recapture is taxed at 25%. Collectibles are taxed at 28%. Life insurance gains are taxed as ordinary income. None of those rates change based on when you sell. But what does change is the effect that income has on everything else. Selling in retirement triggers Medicare surcharges that last for 12 months. It makes more of your Social Security taxable. It pushes you into higher marginal brackets on your other income. And it creates a permanent record in the IRS and Social Security Administration databases that can affect your premiums for years. Selling in your final year of work avoids all of that. You pay the same tax on the sale. But you do it while your income is already high, while you are not yet on Medicare, and while the sale does not create a permanent penalty on your future retirement income. That is the game. The IRS does not care when you sell. They care when the income hits your return. And if you let that income hit your return after you retire, they get to tax it at the same rate while also penalizing you on Medicare, Social Security, and every other income-tested benefit you are receiving. Here is your action checklist. 5 steps you need to take in the next 90 days if you are within 2 years of retirement. Step 1. Make a list of every asset you own that has appreciated significantly. Company stock, rental properties, business interests, collectibles, life insurance policies with cash value. Write down the current value, your cost basis, and the estimated gain on each one. This is your exposure list. Step 2. For each asset on that list, calculate what your income would look like in the year you sold it. Add the gain to your expected pension, Social Security, and IRA withdrawals. Does that total income push you over $206,000 for a married couple or $103,000 for a single filer? If yes, you are going to trigger Medicare IRMAA surcharges. Step 3. Decide which assets you are going to sell before retirement and which ones you are going to hold. The ones you are going to sell anyway should be sold in your final year of work. The ones you want to keep should be structured in a way that does not create a taxable event when you eventually need the money. That means 1,031 exchanges for real estate, 1,035 exchanges for life insurance, and tax loss harvesting for stock positions. Step 4. If you own a business, talk to a tax attorney about whether your business qualifies as a qualified small business under Section 1202. If it does, selling the stock before you retire could eliminate up to $10 million in federal capital gains tax. Most small business owners never ask this question. Ask it now. Step 5. Stop working with advisors who do not coordinate between your tax preparer, your financial planner, and your insurance agent. The reason Richard lost $146,000 is not because he had bad advice. It is because the people giving him advice were not talking to each other. Your financial planner told you to hold the stock. Your tax preparer never told you what that would do to your Medicare premiums. Your insurance agent never mentioned the 1,035 exchange. Retirees who protect their wealth work with professionals who coordinate. Period. Now, before I go, I need to tell you something that most people are not going to want to hear. The strategies I just gave you are not secrets. They are not loopholes. They are not gray areas. They are written directly into the tax code. The IRS knows about them. The Social Security Administration knows about them. Congress knows about them. They exist because the tax code was designed to reward certain behaviors: holding assets long-term, reinvesting in real estate, building businesses. The problem is that almost nobody reads the code, And the people who do read it almost never explain it in plain language to the retirees who need it most. So the strategies sit there unused while retirees sell assets at the worst possible time and pay tens of thousands of dollars in unnecessary taxes and Medicare surcharges that they could have avoided with a single phone call and a different closing date. Richard did not need a complicated tax shelter. He did not need an offshore account. He did not need to do anything illegal or unethical. He just needed to sell his assets 18 months earlier. That is it. Timing. That is the whole game. And nobody told him. I am telling you, if you are within 2 years of retirement and you own any of the 5 assets I just covered, you have a narrow window to act. After you retire, the window slams shut. The assets are still there. The value is still there, but the tax-efficient exit is gone. You will still be able to sell. You will just pay more to do it. This is Arthur Vance. If this video just saved you from making the same mistake Richard made, hit the like button right now. If you are not subscribed yet, subscribe and turn on notifications because next week's video is called If You Have a Pension, the IRS Treats You Completely Differently. Here is what most retirees miss. And that video is going to show you the 3 ways pension income is taxed differently from IRA income, and why most retirees are leaving thousands of dollars on the table because they do not know the difference. If you know someone who is about to retire and they own rental property, company stock, or a small business, send them this video today. The decision to sell before retirement or after retirement is a $50,000 to $150,000 decision. They need to see this before they make the wrong call. I will see you in the next one.